All right. So, welcome, friends, Bell Property Team. We really appreciate you taking the time to listen to this. We just wanted to do a quick market update. I've got a really special guest on today, a very good friend also, Chad Helmcamp from BWC Lending. He's been a trusted resource of ours for some time, and he's definitely a voice that I rely on as well from the lending perspective. So, welcome, Chad.
Thank you, sir. I appreciate it. Thanks for having me on. I'm looking forward to sharing some information today.
Awesome. Hey, well, so big thing that's probably on everybody's mind is the effect of inflation and interest rates that are going on right now. Obviously, today is May 4th, so we're supposed to be hearing some news from the Federal Reserve today, and just as far as a potential rate hike, and how does that translate to the consumer market from a mortgage perspective?
That is a great question. And yes, I have been addressing that question almost hourly, it feels like. It seems like every day we're talking about interest rates and the economy, inflation, and everything in between. And yes, today we have a big announcement at 2 Eastern, 1 o'clock Central Standard Time. The Fed should make their announcement about their intent of raising short-term interest rates. The first thing I'd like to point out is that when the Fed raises the short-term interest rates by 0.5%, that does not mean that mortgage rates go up by 0.5%. Okay, I think oftentimes people hear the Fed raising rates and they think automatically their mortgage rate is going to be 0.5% higher. Typically, what happens is the Fed talks about tightening and slowing down the economy, and the way they do that is they raise interest rates to slow down borrowing. Since they started making those announcements earlier this year, they've already raised the rates a quarter earlier this year. Now that the expectation is they're going to raise rates by another 0.5% today. As a result of this conversation and the inflation talk that we keep hearing, and inflation being at all-time or really 40-year highs, we haven't seen inflation this high since the early 80s. The Fed has been talking about trying to slow things down. Consequently, we have seen mortgage rates move up at really the fastest pace we've ever seen. At the end of last year, we were quoting 30-year fixed rates in the high 2s and low 3s. And here we are in now May, and we're quoting rates in the 5s. So it's been a pretty quick move. And so everybody's situation is different and unique. My hope is that we start to see things level out a little bit. That hasn't happened yet, but hopefully with the announcement today, maybe we'll hear some news from the Fed that will calm the markets a little bit.
That's what we're hoping to. Of course, we have a lot of buyers on the sidelines that they're a little nervous. They see rates going up, and how's that going to affect their buying power? And also there's a lot of sellers that we have clients that are holding off on selling right now because they're afraid that they can't go out and find another house that they don't have to get into a bidding war on. So this is great news if the interest rates go up a little bit, but it calms the housing market down a little bit. Then we'll have the opportunity for those that do need to buy, and they do need to make a shift in their housing situation, whether it mean they move up or they downsize or whatever they need to do. But being able to know that they have another house on the other end, that they don't have to be in a panic of being possibly homeless, and sure. And so they're just concerned about that. So I'm looking at this as a very positive thing that the interest rates are going up. That doesn't affect everyone the best because of reduced buying power, but calming the market is the key, and that's what the Fed's trying to do anyway. Just kind of a question for you. Whenever an interest rate goes up, just by a certain percentage, people kind of freak out. But what does that mean from, let's say it goes up 0.5% at the Fed? How does that translate from an interest rate perspective on the consumer side? Does it mean it's going to go up a point for every quarter point that goes up at the Fed, or is it like, what does that translate to in the consumer market?
It's a great question, and that's what I was trying to communicate earlier is that there isn't a direct correlation between short-term rates and long-term rates. Long-term, and what a lot of consumers don't understand is mortgage rates are traded in the secondary market, on the bond market, much like a stock is. Okay, so stock prices change hourly, by the minute, every day they're changing. Mortgage rates don't necessarily, they can change hourly, and they have, but typically we might see rates move just a little bit each day. But it's based on supply and demand of mortgage-backed securities and how those are traded in the marketplace. And as the price of mortgage bonds go down, interest rates go up. Okay.
Right.
And over the last 6 months, the prices have been going down quite a bit because there's so much supply of mortgage-backed securities out there because rates have been at all-time lows. We've been closing more mortgages than we ever have. And so there's been so much supply of them that the rates have come, the prices have gone way up, the rates have come way down. Now that pendulum is swinging the other direction. And so we're starting to see the price come down and rates go up. When the Fed changes overnight rates, the way that really impacts consumers is it's going to impact more things like credit cards, auto loans, shorter term loans that you take. You're going to start seeing the cost of those loans go up so that it'll slow down the supply. And I like to use the auto market as the best, right? Anybody who owns a car right now knows that for the first time in history, their car went up in value in the last couple of years. That's never happened before. Well, I think if you read enough about it, you hear that the supply chain's all a mess. Automakers can't get the chips to make new cars. So the new cars are not coming to the market as quickly as they normally would. And so it's created a shortage of supply of vehicles. And as such, all auto loans are going up. Well, as the cost of buying these cars is going to go up, as rates start going up, the supply demand feature will start to balance out. Hopefully the supply chain will catch up, and then we'll start to see auto prices start to come back down and normalize a bit. That's what the Fed's trying to do. They're trying to normalize the market from a consumption standpoint to slow down the consumption a little bit. And what I tell people is during the pandemic, we saw the government do things we'd never seen before. And they gave a lot of money away and put a lot of money out into the marketplace, and people have been spending it. That was the goal. Well, unfortunately, they put way too much money out there. And now we're this is the repercussion of all of that money printing that they did. And so now we just have to kind of wait and see how long it takes for things to kind of return to normal, what it was pre-pandemic levels.
Good deal. Well, and just one more question for you. If you had your crystal ball, where are we headed from here on out? Like if, of course, they're expected to raise rates in the next, for the next several meetings to stave off the inflation that's occurred. We're at inflation levels not seen since the 1980s.
Right.
As they slow this inflationary period down, what does that mean for home buyers from a financing standpoint? And like, where are we headed?
Sure.
I know I tell every one of my clients, if I had a crystal ball, I'd be a millionaire right now.
Right.
But I don't. And we work with the data that we currently have to be able to make the best decisions possible at the time. And there's no way we can predict the future.
Absolutely.
But if you had a best guess, if you could put your hat on.
Sure. It's a great question. And yes, I wish I had a crystal ball as well. And I don't know what the future really holds. But what I read a lot about this, and I follow people that I think are way smarter than I am to hopefully try to educate myself so that I can make an informed decision. And here's what I tell my home buyers today. I tell them a couple of things. Rates have moved up to a level right now that some people really can't afford to buy what they really want to buy. That is true. There are some people that have been sort of priced out of the market. Well, if that's true, that's a little less demand, which again was part of the goal, is to reduce some of that demand so that hopefully supply and demand will find that equilibrium mark. But everything that I've read basically tells me a couple of things. Number one, if you need to buy a house and you can afford to buy a house, there's still no better time to buy than right now. And the reason that is because the statistics show that we have been underbuilding homes for more than a decade. Up to 2008, we were overbuilding for more than a decade. Now we've been underbuilding for more than a decade. So we don't have enough supply of homes. The numbers I'm reading are saying that nationwide, we're short about $3 million homes. That's a lot of housing to be short. And so it's going to take time for that market to catch up. Some people think that we could be short on a supply of homes for anywhere from 3 to 5 years. What does that mean? That means we're not likely going to see all of a sudden a $400,000 house be worth $350,000 next year. That's just not likely going to occur. Most people are saying that we're probably going to be that homes will start appreciating more normally at like 3 to 5%. So if we just say 5%, if you bought a $400,000 house today, 2 years from now, that house is going to be worth $440,000. Okay. So still no better time to buy than now. If you can afford the payment on a $400,000 house and you can afford the down payment, then go ahead and buy. As far as interest rates are concerned, I think there's a couple of likely scenarios. One, rates will just continue to climb because of this inflationary environment we're in. So if they do, you'll be glad you bought today and got a rate in the 5s when a year or two from now rates are in the 6s and that house is now $440,000. Okay. Or two, the Fed's going to be successful in fighting inflation, which a lot of people believe they will be. If they are successful, there's a very decent chance that they have a very tough job to do. And most people think a byproduct of what they're doing is going to end in a recession sometime in the next 12, 24, 36 months. Every time in our country's history that we've entered a recession, we've seen long-term rates come down. If that's the case and you bought today, you may have an opportunity to refinance that mortgage into something more affordable in a year or two from now, also when you have additional equity in the home. So that's what I'm telling all my buyers is, if the numbers work for you today and you can find the right house, it's still a great time to buy. If you can't and you want to sit on the sidelines and wait, you can certainly do that. Again, I don't have the crystal ball. I can't predict it, but I just look at it on a case-by-case basis.
Well, and going back to what I mentioned earlier with the rising interest rates, it will slow the housing market down. It'll cool it off. And at most, I hope that we can have a plateau where we're not having competitive bids, $20, $30, $40, $50,000 over ask, calm it down to where, you know, at ask or maybe just a little bit below ask, and we're having normal negotiations, 1 or 2 offers. I don't want that for my sellers. Of course, I want the highest amount of offers and everything, right. But I also have to represent our buyers and sellers equally. And for overall, for the health of the real estate industry, I'm hoping that we get this calming effect so people can get into being able to get into the home that they need to get into. So I'm looking forward to seeing how this all plays out in the next few months. And Chad, I really appreciate your insight as always, and we really appreciate your help with all of our clients and all your knowledge. So thank you so much for joining us today, and look forward to catching you maybe in another month or two whenever we have a chance to get another update in.
Absolutely. Well, I appreciate you taking the time to visit with me, and I think the world of you guys. You guys do a phenomenal job representing your buyers and sellers, and look forward to helping as many people as we can this year.
Excellent. Thanks, Chad. I really appreciate it.
Thank you. Take care.
All right, take care.